Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Coinbase. We'll discuss should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst with Ally Invest.
And I'm Callie Cox, Senior Investment Strategist at Ally Invest.
All right, Kelly, well, we got a little bit of a down day today. I'm actually showing my S&P 500 index chart. And before I pass it to you, I just want to talk a little bit about some of the moving averages. We've highlighted on the 200-day for quite some time now that we're a little bit overextended relative to the 200-day. We broke through the 200-day moving average back in July, and it's been a fairly bullish market ever since then. I guess fairly would be undermining it a little bit. But with that said, the moving average that I find most interesting right now is the 20-day moving average, which is the blue line on the chart here. We see that we became pretty much a little bit overextended all the way since the end of March. And here's a big run up, and we obviously been setting a lot of new highs in a lot of the indexes across the marketplace. But overall, we got a little bit of a pullback, and I just want to highlight whenever we've got a little bit extended on the 20-day moving average, we do usually see kind of a pullback towards that blue line once again. And I'm going to highlight all the way back in September. This was a fairly big one, which is the closest to the distance away from the 20-day moving average as we see right now. All the way back in June, we had kind of that same situation where we got overextended relative to the 20-day moving average. So it's a talking point. It's just 1 point, but we're kind of in that same range. So I wanted to mention that. With that said, what do you see going on in the markets this week?
Yeah, Brian, well, you're right. No matter how you slice it, the stock market's pretty stretched. So I'm going to talk about that in a minute, but I want to walk everybody through what I'm seeing today. Overall, there's not a lot of news on the tape, although we're making our way through first quarter earnings season, which is always important. That's really the big thing on the radar over the next few weeks. This week, we have about 76 S&P 500 companies reporting, and many of them are financials and industrials, two sectors whose profits are especially sensitive to the health of the economy. So this week's earnings season, if you want to have a little motto for it, is how much the reopening economic rebound really helped profits last quarter. We could get some really valuable hints from the companies we see reporting this week to know what we're going to see for the rest of the season. Overall, we are seeing some themes emerge in the earnings we've seen so far, and many companies are beating already high profit expectations, which of course is good news. But it's still very early on, so I don't want to extrapolate too much. And I don't think that earnings are the major driver of the action we're seeing today. Honestly, markets are just a little stretched at this point, and investors are starting to take notice. So we may see stocks take a small step back here and there, like we're seeing today. That's very normal, by the way, even though we haven't seen much of that lately. And we'd expect any dip to be bought pretty quickly. I'll add too that the last 2 weeks have been the lowest volume weeks of the year. So what does volume have to do with market action, Callie? I know. Well, as long as volume stays low and headlines are quiet, we may see the market continue to wander around without any direction or impetus to go higher or lower. It seems like there's not enough reason for stocks to fall because growth is picking up. Economic data looks really good. Earnings look very good. But there also may not be enough reason to push meaningfully higher as we determine how many of these catalysts are already priced in. I'll add too that a market stuck near record highs isn't a bad thing either. I don't hate it. Even the strongest bull markets have stalled at times just to catch their breath, and then they've resumed moving higher. Of course, we can't say for sure that if that's going to happen here. We don't have a crystal ball, but we had to guess based on the fundamentals, we'd still be optimistic about stocks over the next 12 months. We're just kind of going through a quiet period. So, what do you do when stocks are quiet and you want to do something? Well, we haven't had quiet markets in a while. So, appreciate the extra time. But if you're wondering what to do with all this extra time, it could be a good time to make adjustments to your portfolio and maybe rebalance some positions that have done well this year. We're also still seeing a lot of opportunity in more defensive investments, like consumer staples, for example, especially if inflation continues to pick up. So that could be an interesting area to look into. Shameless plug too. Brian and I actually discussed an iron condor trade for S&P 500 options last week to capitalize on quiet markets. So definitely check that out if you want to, use your extra time to, sharpen up your options trading chops. It was a good episode. We talked a lot about some really good things. So look for the April 13th stock play of the day episode in our playlist. So that's the rundown of what I'm seeing in markets, Brian. TLDR, not a lot. So what are you seeing in the VIX these days?
All right. Well, the VIX story isn't as interesting as when we were breaching that 20% level to the downside, but we do see the S&P 500 index, which the VIX, the volatility index, is based off of. That's down about 1% today. So we do see a little bit of a run up in the VIX. I'm highlighting it right now on my screen that we have the VIX up $1.48, trading at 1877, still below that 20% level. Now, what's more interesting to me that I've been highlighting recently on the stock play of the day is that if we do go out to May, June, July, we still see the VIX below the 25% level. But with that said, it's still higher than where the current spot price is at. So the marketplace is still showing a little bit of nervousness, but it has definitely came down recently with the new highs in the S&P 500 index overall. Pretty big down day today. We see a little bit of a spike up in the VIX, which is normal. There's nothing wrong with that. Okay. So with that said, today's stock is going to be Coinbase, COIN. Very interesting stock. Just came out. It's only been trading for a few days. We're going to have to get a little bit creative with this one, Callie. But what do you see going forward in Coinbase?
Yeah, Brian. Well, you're right. We're going to have to get a little creative, and I can't wait to see what you're coming up with because I know you can get very creative with options trades. But yeah, let's talk Coinbase. It's been the talk of Wall Street for the past 2 weeks, it seems like. So, what's Coinbase? Coinbase is one of the world's largest cryptocurrency exchanges, and it went public last week via a direct offering of shares. By the way, I'm suffering from allergies, so if I sound a little off today, that's why we're in the thick of it down here in North Carolina. So, like I said, Coinbase went through a direct offering of shares on Wednesday, and everybody seemed to have an opinion on it. A little cryptocurrency 101. Cryptocurrencies are basically digital coins that can be used to buy or sell goods and services. Many of them have to be bought with a base currency, like the dollar, for example, and they go up and down in value every day. You've probably heard of Bitcoin. That's the most well-known example of a cryptocurrency. And Coinbase is the exchange where people can trade and store coins. So Coinbase's listing was a big moment for crypto. At one point on Wednesday, Coinbase's valuation was near $100 billion, which sounds like a lot, and it is a lot if you compare it to other companies. At $100 billion, it would have been one of the top 100 biggest companies in US markets, which is insane to think about. And, we wrote about this actually on Friday in our weekly viewpoint. I'll have Eric drop the link in the chat, but Coinbase could be a popular way for investors to get some exposure to crypto without having to pick a single coin. We like the fact that it's a crypto connected investment with transparency into its financials and cash flows. So it's a little bit easier to figure out what it's worth, what the true value is. And we're very intrigued by cryptocurrency and blockchain. And we think this could just be the beginning of crypto's story as a transformational space for many industries, including finance. Like I said, we wrote about it in our weekly, so definitely check that out. I see Eric dropped it in the chat. So yeah, easy to say that we're pretty excited to see how crypto matures and how the space changes over the long term. But we're here to talk about the short term. So short term, Coinbase's stock could be pretty volatile, Brian. There are some pretty legit arguments on both sides in the short run too. So I'll go through both. So the bull case for Coinbase is that crypto trading has picked up recently, and that's, kind of putting it lightly. It's picked up a lot. And Coinbase has captured a significant swath of that business. Coinbase is also able to charge some pretty hefty fees for buying and selling, which has helped its revenues and ultimately its profitability. Yes, when it came to market, it was a profitable company. It is a profitable company. So as crypto matures, Coinbase could benefit. And, Coinbase has the all valuable first mover advantage as well. So what's the bear case? There's always a bear case. The bear case for Coinbase is that the valuation may be too high. That's the main argument for skeptics. And that Coinbase could easily get undercut by a competitor who comes in and charges lower fees for trading. Fun fact, over 96% of Coinbase's revenue comes from trading fees. So its success is largely dependent on charging those fees. And there are always inherent risks in investing in any up and coming company. So it's not just a young crypto company. It's, something we think about with every young company. So right now, if you look at Coinbase's stock chart, you can see that the bulls and bears are really battling it out. And the share price is swinging back and forth, right around the 320, 330 mark. So Brian and I, we were talking about it, and we think there could be an opportunity here to position yourself in case there's more volatility up or down in the stock as the market digests just how much Coinbase is worth. So Brian, time's up. I want to hear your creative trade. But before I pass it to you, I want to remind all of our viewers to drop your questions in the chat because Brian and I will be answering your questions live at the end of the show today. Give us a challenge. We're here for it. So Brian, I want to hear about your trade.
All right. Well, last week, as you mentioned, we actually got a little bit creative and we did an iron condor. And that was one of the first times we've ever talked about an actual iron condor, that strategy on the stock play of the day. And we're going to break some barriers today, too. We're going to look at a long strangle inside the options playbook. So right now we see Coinbase is down about 5%, which is actually down since we started talking here. And the strategy, which I'm going to highlight inside the options playbook, is a long strangle. Now, very rarely do we talk about long strangles and underlyings. And the reason why is that it's not a high probability trade. A long strangle means that you're not quite sure of the direction, but also the options are really expensive. And one of the things about Coinbase is we only have monthly expirations at this point in time. And part of the reason why is that it's a brand new stock. It's only been out on the marketplace for about 5 or 6 days or so. So with that said, we're going to look at buying an out of the money call to get some volatility on the upside and an out of the money put to maybe look for a little bit more downside. Our real forecast here is that the volatility in the underlying is going to be much more than expected by the marketplace. And I'm going to highlight a couple of these things. Now, I'm going to emphasize this today. This is not meant to be a recommendation. This is always intended to be a learning situation when we talk about these strategies in the stock play of the day. But today, specifically, because we're looking at a very speculative strategy on a very speculative underlying, but it's kind of, it's what everybody's been talking about and that we've actually addressed in our weekly outlook that we put out this week. We talked a lot about Coinbase and about crypto just in general. So you're going to want to check that out on the Community Hub. We do have the link inside the chat box right now if you want to go and check that out later after the show. Don't leave us right now. So let's go in and let's look at the chain. And I'm going to point out a lot of interesting things that are going on right now in Coinbase. All right. So here's the Ally Invest option chains. On the left-hand side of your screen, you're seeing the calls. On the right-hand side of the screen, you're seeing the puts. And I'm going to highlight here that these are all the expirations that are available, May, June, September. I expect that to change, but right now it is what it is. So we're going to use the May expiration, and I'm going to highlight some of the volatility and some of the things that I see that are not necessarily normal in an underlying that has been established, that's been trading for a while. I would say, a better word would say not real natural and as far as the marketplace is concerned. Okay. So right now we're at 30, we'll call it 320 because I want to make the math fairly simple. if we're looking at about 320, if we go 30 points to the downside and we look at the price of the put. So let me scroll down here. We're at 320. If we go 30 points, that would be, in this instance, 290. We see that the implied volatility, which I'm highlighting right here on that option contract, is 68% approximately, and that asking price is $12.60. Now let's go 30 points to the upside in this situation. If we call it 320, 30 points to the upside would be about 350. And we see that this option contract, the call option, is trading closer to 70% implied volatility. But more importantly is just look at the price. Equidistant in and out of the money, we're trading at about $14.90 on the call versus $12.60 on the put. The calls are way more expensive than the puts right now, just showing that there's a little bit more demand for those call options, which isn't always the case. A lot of times when you're looking at option chains, specifically in indexes, you will see that put options, equidistant out of the money, will trade at higher volatilities than the call options, meaning that they're more expensive. A couple reasons for that. Specifically in indexes is a lot of people will use those option contracts as hedges. You got a lot of money managers that want to use it to hedge their portfolio, and one of the best indexes to use is obviously the S&P 500 index because they own a lot of the stocks that are in there. Now, as individual stock is concerned, that's not always the case, but most of the time you will see puts trade at higher implied volatilities. And part of the reason why is that stocks have a tendency to go down with more velocity than go up. So it's just a talking point, kind of like the 20-day moving average that we mentioned on the chart today. It's just a talking point to point out the fact that if we go equidistant out of the money on the call options versus the put options, you're seeing the calls trade at quite a bit higher dollar amount than the actual put options. Okay, so this is where the creative part comes in. We can't really do a shorter term option contract because we only got the May expiration, but I'm going to look at doing a long strangle. And part of the reason why is that I see the volatilities right around 68%. Relative to what we've seen happen so far in the stock, I think volatilities could go a little bit higher. And so all we were really looking for on a long strangle is we want it to move, but we want it to move some way in a hurry. And also we have the stock play of the day overtime, which will be this Friday. And I would definitely make an adjustment on this trade if I'm going to buy a long out of the money strangle going out over 30 days. And we're going to have to pay a little bit of premium. So this trade isn't for the light of heart as far as an option strategy is concerned. It's going to be a fairly low dollar amount compared to buying the stock outright, but it's also going to be really speculative because we really need the market to move more than what the implied volatility is saying it will move over that short period of time. All right, a little bit long-winded here, but I think I feel like it's needed. We're already back up to 320, which it was just 318 a couple of minutes ago, but that kind of helps me out. I want to pay attention to the long straddle, okay? I'm going to highlight over here in the left-hand side that the May 21st expiration is 31 days away. 320 is the at-the-money option contract. We're going to buy the 320 strike call and at the same time buy the 320 strike put to get a feel for the expected move. Now, that's not a strangle, that's a straddle, but it gives you a hint as to what the marketplace is thinking could happen over the next 31 days in Coinbase. So if I scroll down, I see that we got about a $51 move. Let's round that off to 50. It's not an exact science. And we're going to go about 50 points out of the money on the put side and about 50 points out of the money on the call side. Why? Well, this is the expected move. The marketplace thinks that this is the line in the sand. This is the over-under on what could happen. Our outlook is that it's going to move more, either in one direction, we don't really know, but that it's going to move more in one direction. Now, the downside here is that we got to pay up for the call. Like I mentioned, the implied volatility skew is skewing towards the call. There's more demand for call options overall is what that is saying in general. And that's just a general concept. And that has driven up call prices relative to the puts. So let's get to today's paper trade after that long-winded explanation. Okay, so I'm clearing out the long straddle. We know that that's basically the expected move. And we're going to go 50 points, the expected move on the call side. That's 370. That's trading for $10.30. We're going to be buying that one. And then on the put side, we're going to also go 50 points. So 20 would be 30, and then we'll go another 30 points from that would be down to 70. And now look, when we get this far out of the money, this 270 strike call is $6.60. Where I'm sorry, put. I'm on the right hand side. I'm on the put chain. That is $6.60. Now let me scroll down and look at the call. That is $10.30. So even the further you get out of the money, there just seems to be more premium on the call. So it even becomes more skewed the further we get out of the money. Just once again, an interesting talking point. All right. So here's our official paper trade. Once I put it in the right rail, it becomes the official paper trade for the day. And I'm going to highlight once again, not meant to be a recommendation, but here's what we're looking to do. We're buying open one of the May 21st expiration 370 strike calls. Buying open one of the May 21st expiration 270 strike calls. Now, interesting, it's exactly 100 points wide by looking at this. So looking for a fairly big move. We're going to do this at a midpoint price. Right now it's $16.05. That means that we pay $1,605, so fairly expensive, and we're buying out of the money option contracts. But that's going to be our official paper trade for this week. So 16.05, we'd want to work the midpoint. They're fairly active options already. I would think we would get filled somewhere near that price, but it's never a guarantee. And don't forget to add commissions in whenever you're doing your trade and your risk analysis. All right. So I'm going to get rid of that little quick trade. We still got some time. Please put your questions in the chat box. We're going to be ready to answer them, and I have a feeling we'll have quite a few today. All right, so I'm going to zoom in here. All right, so here was the long, and I'm going to highlight on the screen in the playbook. This is at expiration on a long straddle. This is in the profit and loss graph. This is live. And you see here that if we put this trade on, to start with, we don't have a lot of risk. The colored line is highlighting your risk. Our risk to start with is going to be a decrease in implied volatility. That's probably going to hurt the position more than the actual time decay. So we got to pay a lot of attention to what could happen to vols. Now, overall, we're skewed a little bit to the upside from where we're at, and you can kind of see by that smile. Now, what I'm hoping to do on a trade is if it does lean one direction, let's say it goes up, okay, we're looking for a 50-point move. Let's say it moves 20 points by Friday in one direction. I'm going to think hard about selling either a call option on the upside to help pay for the put and the losses that would be occurring on the put, i.e. logging into a long call spread or a call debit spread. Or if we got a 20 or 30-point move to the downside, maybe think about doing that on the put side. Now, we're going to determine that on Friday, so you're going to have to come back to the stock play of the day overtime to look at that or to participate in that discussion. And I do hope that it would be a discussion because once again, we're breaking boundaries here. Not a lot of times, and I don't anticipate that I'm going to be thinking about a long strangle in almost anything. The last time I think I talked about a long straddle / strangle, they're both kind of the brother and sister, straddle and strangle, is when we talked about Boeing way back when they had all their trials and tribulations, and they actually worked out fairly well. But that was the last time that on any stock play of the day that we actually talked about these fairly speculative strategies where you're buying a lot of premium overall. All right, so that's the paper trade for this week. And I can highlight it right down here. This is actually the workbench for the P&L calculator that we have here. And I think we open it up for questions. We got any in the chat box, Callie?
Yeah, well, like Brian said, it's a historic day for stock play of the day. And I told Brian I was going to challenge him this week. So that definitely seemed like a challenge. But it's a really exciting trade on a very talked about stock that we've seen that's really been in the news a lot over the past few weeks. So yeah, Brian, we have a few questions. So I'm seeing our first question from COD Yes. I wonder if that COD stands for Call of Duty. All right, so COD Yes, hi, asks, what are hedges and what do you mean by people trying to hedge their portfolio?
Oh, excellent question. Yeah, sometimes I do talk with a little bit too much industry jargon, and that's on me. I need to explain those thoughts a little bit more. But if I'm hedging a portfolio, that means that I'm buying protection for that portfolio. You can almost think of it as buying insurance on your car. You're hedging yourself, you're hedging your bet that you own that car option and that you're not going to drive it into a tree overall. So that's my protection. That's my hedge, is my insurance policy. If I buy a put, it protects me from a downward movement in the marketplace. So a hedge is really another term for a way to insure your portfolio of stocks, if you're doing it at an index, or your specific stock like Coinbase, Apple, Amazon, whatever you own of that underlying. A hedge would be to say, I own 100 shares of Coinbase, which would be fairly expensive, and I want to buy a put to protect against the downward movement in Coinbase, if that were the case. Now, as with most hedges, though, when you're doing it, it means that you're bullish, but you're nervous. In other words, you still anticipate the market to go up. When you buy your car insurance, you're insuring against a potential loss, but you really don't want to crash your car into a tree over that period, right? So ideally, the bull case is if you're buying a hedge or you're buying protection, you want your underlying to continue on up, but you're protecting yourself just in case it doesn't. And that's what a true hedge would be in the marketplace overall.
Yeah, awesome answer. I love the insurance analogy. And then a follow up from COD, yes. And I know we have an answer for this one. They ask, is there a webinar to teach about option trading? And, we can't make recommendations, but they also asked, is option trading the best fit for college students? Yeah, I'll pass it to you, Brian. I mean, short answer is we have a lot of resources.
Yes, we do inside our community hub, where we actually do have that highlighted in the chat box. You could click on it to get to the community hub. We do have some basic videos on options, about option pricing, what is an option contract, and every once in a while we do hour-long seminars that cover the basics and some of the basic strategies. Now, is it feasible for a college student? Options can be used in many different ways. Options can be used to protect a portfolio. They can be used just in general as a way to own some stocks without all the risk of owning stocks. We highlighted those on a lot of the stock plays of the day. We call them FOMO trades overall, where we're just buying in the money options, just one, because we're going to buy 100 shares of stock as a surrogate for the stock. So options can be used to increase risk, like we're doing today, or they can be used to reduce risk. It's all about how you want to approach them. So for a college student to learn about options and have it as a tool in their toolbox for investing, I don't think there's anything wrong with that whatsoever. Now, if you don't take the time to learn and you just use options to speculate, well, that doesn't make sense, because obviously if you're a college student, you have well, I guess it's not obvious, but in general, you would think that you have limited resources overall, and you don't want to lose your college tuition just speculating on option trades in the marketplace.
Yeah, great answer. Great answer. All right, so speed round for you. We have a question from Wayne. Wayne says, "Hey, Callie, don't drown in pollen." Too late, Wayne. I'm already there. And then he says, "Brian, question for you. When doing a debit spread, is there a specific percent of premium that you ideally want to have an intrinsic value compared to the percent of your premium that is time value?"
All right, one more time, Callie. I didn't quite catch all that.
That's okay. So Wayne says, "Hey, Brian, when doing a debit spread, is there a specific percent of premium that you ideally want to have an intrinsic value compared to the percent of your premium that is time value?"
All right, Wayne, that is a great question, and we've talked about that. In this instance, this question doesn't really apply. If I was looking at just speculating on a short-term move, maybe in a different underlying, yeah, I would look at how much time premium I am buying on the long option versus how much time premium I am selling on the short option. And those, we've talked about that concept a few times in the stock play of the day, but it's not really relative to this strategy, because we're going to put this on, we pretty much know that it's not going to be exactly where it's at right now. It's a fairly decent guess that Coinbase by Friday is going to move somewhere in either direction. It's not guaranteed, of course, but odds are that it will. And then we're going to look at making an adjustment to this strategy. Because the one thing I don't like is that we went out so far in time, we have a lot of risk just based off of what we had to pay for this underlying. And in the stock play of the day, in my own portfolio, I'm okay with it. But I don't necessarily know if that's a good amount of risk. So we're probably going to look at an adjustment this Friday, but it's not going to be based off of the amount of time premium. It's going to be based off of the movement of that underlying stock. But great question as always, Wayne. It's always great to have you back. You always ask great question overall. All right, we got a few more. Let's push on, even though we're kind of past time right now, Kelly. I see a couple more great questions in here.
Yeah, definitely. Let's keep going. All right. So I have a question from Ted Myers that I'll take, Brian. So Ted, hey Ted. Ted asks, what is your near future pick for a dividend paying stock? Well, Ted, I like to look at, I and Lindsay Bell like to look at, the market on a sector level and then, on maybe like a broader strategy level as well. Excuse me, I have allergies. We right now, our market outlook is for the market to maybe stay, flat, maybe go slightly higher over the next few months. And we think that the market will rotate into, more defensive investments. The reason why I say that is because one of those defensive areas is consumer staples. Consumer staples, think like the Procter & Gamble's of the world, the Johnson & Johnson's, the Walmarts, things that consumers really need, and they can't, they're not consumer discretionary. The customer is going to buy it regardless of their income or needs. But I mentioned consumer staples because consumer staples tend to have a higher dividend yield as well. And dividend stocks in general, it's a great time in the market for dividend stocks to, outperform since 10-year yields are so low, bond yields are so low, and we're in the early phase of an economic recovery. And dividend paying stocks tend to get more profit, or they tend to perform better as the economy grows. So it's a great time for dividend paying stocks. We especially like consumer staples. And we definitely encourage you to dig into that space and see what you can find there. All right.
Kelly, let me jump in and take the last one here, and I'll let you deal with your allergies. Okay.
That one's for you.
So this will be the last one, and I'll give you a little bit of a break. So we had a very quick question from COD. Can I hedge a portfolio? The answer is yes. Way too long of a topic here, but I would definitely look for videos based off of how to hedge a portfolio. You can find some of them inside our community hub, as mentioned earlier. Now, with that said, I do like the last question too that I would like to address, and this will be the last one for today's episode. We have 510 KPP, all right? Easy for me to say. How do you determine the width between the strikes for the straddle? Now, strangle, for the strangle. I keep wanting to say straddle. Straddle is a more common strategy than the strangle. But the strangle, how did we determine the widths? We looked at the expected move. So if you missed that earlier, you might want to go back. Once this video will be live, you'll be able to watch it as soon as we finish up here, and go about halfway through my strategy talk. And I mentioned that we use the expected move. By the expected move would be buying the at the money call and buying the at the money put, which was about 50 points, to pick how far out of the money we were willing to go with our long strangle. And we wanted it to be within that range. In other words, we were expecting more move than what the marketplace is expecting. That's why we're doing this strategy. If you don't believe that, then you shouldn't do this strategy at all. But it is just meant to be a paper trade. So we're saying the market is expecting about a 50-point move over the next 31 days. We're going to say that it's going to be more. We just don't know the direction. So we bought the long strangle. Not a very common strategy because you got to put a lot of premium up to do that. But that is our outlook. We're going to come back on the stock play of the day overtime this Friday. And we're going to talk about, well, how would we adjust the strategy? Or maybe we just stay the course. We'll see what happens in the marketplace. So with that said, I think this will be it for this edition of the stock play of the day. Come back Friday for my episode of the stock play of the day overtime. And I want you to click subscribe and ring the bell. That way you'll get all the notifications for the next stock play of the day. Thanks for coming, everyone.